Okay, just so everyone knows, we are recording this so that it can get posted on our website to be viewed. People who aren't able to join us. So sorry to interject, but yes, go ahead, Bob.
Thanks, Rachel.
Yeah, that's fine. Thank you, Lisa. Thank you, and welcome everyone. We're a little early for tax season, but it's never too early to begin planning. That's for sure. As Lisa indicated, what we're going to do here, what I will do here is do a bit of a presentation, and at the end we will respond to any and all questions that you might have. Very importantly, in the event you wake up at 2 o'clock in the morning and have a question, as you can see on the very first slide, there is my email address. Feel free to send me an email. I typically will respond to it the next day. So if you have any questions that pop up after we get through this session, because right now, I'm sure the last thing you're thinking about is taxes, but the fact of the matter is there's some things you need to begin to think about and get ready for before the end of the year. And it would be helpful to have this information. And like many of my clients, this October 15th is the final filing deadline for 2020 income tax returns. And I have a number of clients who wait till the last minute. So we have people that are well prepared, people that aren't so well prepared, but in any event, we'll get through this and we'll answer all of your questions. All right, if you can move on to the next slide. Just basically what we're going to address today, I'll introduce you to some tax forms that you need to be familiar with. And again, I would say, maybe for many of you, this may be a little redundant, so to speak, but I hope there are some specific items throughout this discussion that I suspect will be new to you. So hang in there. I'll try to be as entertaining as possible so that we can get through this without any stress, so to speak. So we're going to view some tax forms, talk about filing requirements, talk about reportable income. We'll get into paying estimated taxes and your responsibility there. We'll talk about some tax credits that may be available to you, the ability to deduct your student loan interest if you have any, and then we'll talk about state income taxes briefly, and then finally wrap it up for, again, as long as necessary with the question and answers. So if we can move on to the next slide. All right, here we have, it's a little bit dated. It's a 2019 Form 1040. What you're viewing there is basically what will be used for the 2021 tax season will be pretty much the same. There might be some slight modifications, but what we have here is Form 1040. This page 3 of the slide is the front side of the form, and then we'll be moving on to page 2 of the slide, which is the back side of the form. So here you have it starting at the very top. As you can see, basically what we need to do is identify who we are, the taxpayer, name, address, social security number. And this is a printed version of the form. More and more individuals annually, and I encourage it, more and more individuals are filing electronically. In this particular past couple of tax seasons, the need to file electronically has been very important, especially for those of you who were looking for refunds. With this COVID situation going on, the IRS was shut down for a considerable period of time. And as a result of that, if you filed a paper tax return, your paper tax return could very well be for the 2020 tax season, could very well be in some pile somewhere at some Internal Revenue Service office, not processed. And that's what I'm encountering. I have a number of clients who filed paper returns and are wondering whether the returns have been processed, are waiting on refunds. So I encourage you to file electronically, and I venture to say that most of you will probably be using some type of tax software. I suspect probably TurboTax, which is a very, very good product, which allows you to file electronically. So I would encourage you to file electronically, and something's good. Is that on your end, Lisa? Okay.
Yeah, that was me, sorry.
All right, no problem. I wasn't sure whether it was my PC or not, but that wouldn't be the case. In any event, filing electronically is going to speed up the entire process for you. So that's very helpful because there's nothing nerve-wracking than waiting for a refund. And then those individuals who are waiting for a refund, in terms of my clients, they'll pick up the phone and ask me what I can do. And there's absolutely nothing I can do to speed up that process. Is there anyone you can call to try and get through to the Internal Revenue Service these days? It's painful, extremely painful. You could potentially be on hold for hours on end. And hopefully during that waiting period, you don't get disconnected or whatever the case may be. Or and there has been cases where there's been so much of an overload of phone calls, the call is terminated and the IRS makes reference in a recorded message that due to the call volume, we suggest you call back tomorrow. So again, try and avoid that type of situation. So back to the form, again, entering your name, address, social security number. And then from there, is really not, for most individuals, for most of you, there's really not going to be much going on with regard to what you're going to reflect on the form itself. Chances are you may have an entry on line one. And on line one of the tax form, it refers to, and I'm sorry that red arrow there is sort of blocking some of it off, but I did put that arrow there for a particular reason. But basically, line one is where you enter salaries and wages that you've earned. So in this particular form, we have an amount on line one, which is $33,600. And we'll talk about what that amount represents momentarily. And obviously, as you can see, that same amount continues to be entered on line 7B and 7B and 8B, if I can read it correctly. But in any event, it's just the total. So this particular taxpayer has one amount to report. It's $33,600. From there, on line 9, there is an entry, and that entry is what is known as the standard deduction. The amount entered there is a standard deduction amount of $12,200. Now, that was the standard deduction that was allowed all single taxpayers in the year 2019. So basically what the government, what the tax laws, the US tax laws allows you to do is report your income. And as you can see, your total income, your adjusted gross income on line 8B is $33,000. From line 8B, you subtract line 11A, which is the total of your standard deduction. So you get to reduce, no questions asked, you get to reduce your taxable income or your adjusted gross income by this standard deduction. For 2020, the standard deduction is increased, and it increases as a result of a statutory increase. The government increases the standard deduction by some type of inflation index. So for 2021, I'm sorry, the standard deduction for a single taxpayer is $12,550. So again, that's a no questions asked deduction. You get to reduce your income by that amount. So this taxpayer has on line 11B, I'm sorry, a taxable income of $21,400. We're not going to move to the next page yet, but basically the next line on the second page is the total tax. And in this instance, the total tax in 2019, granted, on $21,400 of taxable income is $2,377. And we'll see that in a moment. So basically, the tax on that sum of income for this particular taxpayer in the year 2019 totals $2,377. So that just gives you an idea. Basically, for federal income tax purposes, we have a graduated tax rate. The tax rate starts off at 10% and it escalates to as high as 37%, and it gradually increases as your taxable income increases. So we have a graduated tax rate for US tax purposes. For example, for Massachusetts state income tax purposes, which may apply to many of you, Massachusetts has a flat tax rate, which is roughly 5%. So as you get, as you earn more and more income, the tax rate remains the same at a flat 5%. So now, to point out that red arrow, we're going to talk about, and I would say for many of you, one of the reasons you're participating in this, this presentation today is to, you heard the rumor that some of your financial aid or your financial support or whatever you want to call it is taxable. And we will talk about that in greater detail momentarily. But basically, once you have determined what portion of your financial aid is taxable, it's going to show up on line 1 as you see it there. And to the left of that amount, you're going to see a notation SCH. And what that denotes is scholarship. So basically what you're doing, normally on line 1, taxpayers report whatever wages or salaries they earn. But in addition to the reporting of salaries and wages that you might earn, all taxable scholarships and fellowships are reported on line 1 as well. Excuse me. In that notation, SCH is reflected to the left of that amount, as you can see it. So, point I'm trying to make here is this. If you're using a tax software like TurboTax, you want to make sure that your data entry, when you're preparing your return, you want to make sure that the amount that you're reflecting on line 1 is notated as a taxable scholarship. And that all happens as a result of properly entering in the amount in the appropriate menu within TurboTax or any other software that you might be using. Excuse me. The end result, again, whether it's TurboTax or any other software, you should see in the final product, the return, that notation indicating SCH. So I want to bring that to your attention so that you make sure you're heading in the right direction. Because if you enter amounts incorrectly, inappropriately, they may be treated differently within the tax return. So you need to be aware of that. So again, for many of you, the only amounts you might be reporting would be these stipends, and they would be reflected on that line as such. All right, let's move on to page 2 of the form. So as I stated earlier, page 2, it's the backside, obviously, of page 1. Excuse me again. And what we have there in the very first line is line 12B, reflecting the tax, $2,377. And as you can see, I'm not reflecting anything else on the tax form, except for the fact that this particular taxpayer on line 23 has an amount due of $2,377. And we'll talk about how that particular tax liability would be paid under these circumstances in a moment. So that's the backside. And again, we're looking at a very, very basic return. I'm sorry, if you could go back to that previous slide, I'd appreciate it. As you can see, there are other lines. If you have other sources of income, if you have interest from bank accounts, if you've received dividend income from stocks and bonds and things that you might be invested in, those amounts would also be reflected on this particular schedule. And then there's, if there are other amounts, which I suspect, IRA distributions or pension distributions, I suspect at this point in your life, you're not dealing with any of that. If you sold any stocks or bonds and there was capital gains involved, those amounts would be reflected on line 6 and what have you. So at one point in time, prior to 2018, we had 3 different tax forms that we would be filing: a Form 1040, a Form 1040A, and a 1040EZ. Those Form 1040A and 1040EZ have been eliminated. There's only one tax that all U.S. individual income taxpayers will be filing, in its Form 1040. So there's no need to worry about if you're filing the right form or not. So all your income will be reflected on Form 1040 somewhere within page 1 or any of the schedules that are attached to the Form 1040 that would bring that amount of income in. So all right, let's move on again back to the next page. All right, one other point I want to bring to your attention is where that lovely red arrow is pointing, is there is a section on the return where in the event you are getting a refund, starting on line 20, where you indicate that you have an overpayment and so forth and beyond, you have lines 21B and D and C and so forth, where you are able to, if you are going to be receiving a refund, where you are able to enter in your banking information so that the refund can be automatically deposited to your bank account. Wonderful idea. I encourage you to use it. Some people are a little squeamish with regard to issuing bank information. I can't blame you today, so to speak. The IRS really has, in comparison to some of the major companies out there that have your personal information, and we've all heard those companies in the news get hacked, and personal information has been released. As far as I'm aware, the IRS systems have been very secure, and there hasn't been any issues with regard to any of this information being disseminated. So I encourage you to have your refunds paid to you electronically. First and foremost, the reason for that, if you ask them to send you a check, it's going to be weeks, if not months, before you see that payment. When you file electronically, and hopefully things will be getting better and better and better. Prior to this dreaded pandemic, taxpayers were filing their returns electronically and getting their refunds as quickly as a week's time, a week to 10 days. So that's, that's unbelievable. So if you file electronically, your return goes into the IRS system automatically, it gets processed, and payments are made fairly quickly. Of late, things have slowed down, to tell you the truth, and that's only because of just the tremendous backlog. But even still, taxpayers are seeing their checks, refunds deposit as quickly as a couple of 3 weeks. So that's certainly much better than 6 to 8 weeks. So, keep that in mind. And for you folks, you're of the mindset, to do these things electronically from that standpoint. It's sort of the older generation that typically shies away from sort of doing these types of things, but by all means, file electronically. All right, let's move on to the next form. All right, what we're seeing here is a actual with the names and addresses and relevant information whited out, a W-2 form issued by the university to a taxpayer for compensation wages that individual earned. This is what the W-2 that is issued or has been issued in recent years from the university looks like. Basically, that section there, that's the upper right-hand corner of the form has been pulled out of there because it obviously contains some personal information. So we pulled that out of there. But basically, what you would get from the university, if you were compensated by the university, is a form that looks like this. It's a W-2 form. W-2 forms are generally issued by employers to employees to reflect the earnings or wages that an individual has received for the calendar year and what taxes were taken from those particular wages. One thing to keep in mind when I made reference to the calendar year, when filing a tax return, we are what are called calendar year taxpayers. Our tax year begins in January and our tax year ends on the last day of December. So we're calendar year taxpayers. So any amounts that you constructively receive within that time frame would be reported within that tax calendar year. There are no taxpayers, individual taxpayers that have something other than a calendar year for tax reporting purposes. So again, if you've been employed, whether it be by the university or any other employer, you should expect and anticipate to receive a W-2 form at the end of the year reflecting the wages that you've earned. Now, those of you who are receiving a stipend of sorts from the university, you will receive absolutely nothing. The university is not responsible or under any obligation by the government from, the W-2 form is issued as a requirement of the government requiring employers to issue W-2 forms. Any type of form that is in the W-2 form, keep in mind, there is a rhyme and a reason behind the need to file a W-2 form, the employer preparing and issuing W-2 forms. Not only does a copy of the W-2 form go to the individual who earned those wages, but a copy of it also goes to the Internal Revenue Service. And of course, at some point down the road, maybe a year and a half after you filed your income tax return, these W-2 forms are being matched to returns that have been filed. And obviously, if there are any discrepancies, those discrepancies will be brought to your attention in terms of whether you reported that income or not. And the discrepancies typically result from individuals receiving a W-2 form, but not reporting that on their income tax return, whether intentionally or unintentionally. But basically, there's the checks and balances. And there are other forms that are issued for the same purpose. When you receive interest, dividends, and so forth, you would get a form at the end of the year. But back to your stipend, the university nor does the government require any type of document to be issued. It's your responsibility to establish what you have to report. Obviously, the IRS is not getting a copy of anything from the university in terms of how much of a stipend you've received. And obviously, I'm sure, I'd be willing to bet that over the years, there may have been one or two students who may have violated tax laws by not reporting the stipend that they received. And there's a very good likelihood that there were no implications from that, because there's just no system of check and balance. But our tax system, it's a voluntary system. We are all required to report our income from whatever source derived. And, if you've earned income, you must report it. That's your responsibility. Obviously, in most taxpayers that I've encountered over the years are responsible and do what they have to do from that standpoint. So as far as establishing how much of a stipend you've received, it's my understanding you do have online access and can produce, print out, view some type of year-end earnings report, which will provide you with the total earnings that you've received. Sometimes I get a question with regard to, I know at the end of the year, the so-called January stipend is paid in December. The question is, when is that taxable? It's taxable when received. So if you receive, I think basically the university, it's been the university's policy to advance that January stipend prior to the semester ending, and that would be sometime in December. But the bottom line is, when that money, those funds become constructively received by the individual, available to you, that's when it's reportable. And those amounts would show up on that final earnings statement that the university would present to you. All right, let's move on to the next slide. All right, let's talk about some filing requirements. Who's required to file? For federal, basically, all U.S. citizens and resident alien taxpayers will file Form 1040. When we talk about resident alien taxpayers, we talk about those individuals with green cards, so-called green cards, alien registration cards, or those who have been substantially present in the United States for a requisite period of time, would be filing as U.S. citizens. And as a U.S. citizen, you report all of your income from all sources, whether it be domestic or international. All income that you've earned is reported on your U.S. income tax return. So for this slide, we've got a change. I apologize. For 2021, the income thresholds requiring the file of a federal income tax return are as follows. If you are a single taxpayer, you, and under the age 65, you must file an income tax return if your adjusted gross income is greater than $12,550. Now, if you recall, back on page 1 of the presentation, I indicated that for 2021, the standard deduction for a single taxpayer is $12,550. So no coincidence. So bottom line is this: if your income exceeds your standard deduction for the filing status that you're filing under, you must file an income tax return. So for single individual under 65, it's $12,550. For a married couple filing jointly, it's $25,100, and it's no coincidence. The $12,550 is doubled to $25,100. If for some reason you are married, but will be filing separate returns, and you're under age 65, if your income is $5 or more, you must file an income tax return. There's reasons for that we don't need to get into. And if you are determined to be a head of household, a taxpayer who is supporting a household for a dependent, whether it be a parent or a child, your standard deduction is $18,800. And then if you're a single taxpayer who's a dependent of another taxpayer, if you have unearned income over $1,100 or earned income over $12,550, or your income is greater than 1,100, or the earned income up to $12,200 plus $350. But basically, again, if your earned income is over $12,550 as a single taxpayer, your earned income, or if your unearned income is over $1,100, you have to file a return. Now, it's possible for many of you at this stage of your life, you may have earned under these thresholds. So you worked at the the local CVS or the Walgreens or wherever, local grocery store, whatever the case may be. You may have earned some money working a summer job or something like that, and you earned under the threshold. And it's quite possible you didn't have to file an income tax return. But it's quite possible that while you were working, your employer did withhold some federal and or state income taxes from your pay. And if your employer withheld federal or state income taxes from your pay and you were under the filing threshold, you would owe no income tax. So what happens to the amount of federal and or state income taxes that were withheld from your pay? Well, if you don't file a return, you will never get those amounts back. You need to file a return, and there are a lot, and I see it from time to time. I have a lot of taxpayers that have, high school, college students who work part-time jobs, have no other source of income, and it may have had federal and or state taxes withheld from their pay. That money is yours. But unfortunately, unless you file an income tax return and ask for it back, you will not receive it. So if you have a situation that occurred like that over the last 3 years, and the reason I say last 3 years, the statute of limitations basically runs out in 3 years. If you don't file for a refund that you're entitled to within a 3-year statute of limitations, and you attempt to file for a refund after that statute closes, the government is going to say, I'm sorry, tough luck. But, it applies both ways. In the event the government comes after you for more money after the 3-year statute, tough luck on them. And typically they don't anyway, unless there's some egregious tax violation that you were involved in terms of not filing an income tax return when you had to, et cetera, but we don't need to go down that route. So this schedule here reflects when and how and why you need to file. So keep that in mind. So if you have some old W-2 forms, when I say old, if you've had any income in 2019 or 18 that had taxes withheld from it, you might want to think about filing a return to get that money back. So keep that in mind. All right, next. All right, next slide. Here we are continuing with regard to filing requirements. And this is something you all must keep in mind, and you may have to coordinate this with your parents if it does apply. But basically, there's this so-called kiddie tax. Excuse me. And what the kiddie tax basically is I believe some 20 years ago, the government was trying to close some loopholes. And one of the loopholes that the government attempted to close is basically the conversion of income to a lower paying taxpayer. In other words, parents were shifting income to their children. And as I stated earlier, the federal tax system is a graduated tax rate. So if you have a parent, two parents earning a couple, $300,000-$400,000 of income, they're in a much higher tax bracket than Johnny and Sally. So what the parents might do is shift income to the children in terms of bank accounts, where they're collecting interest and dividends and so on and so forth. and effectively paying an overall lower tax on the combined income. So government in their infinite wisdom, saw through this and said, okay, we're going to institute, and this is, as I believe I indicated, this is something that took place about 20 years ago. Government basically instituted this so-called kiddie tax. Now, it applies to children under age 18 and certain other children described below with unearned income over $2,200. This income is taxed at the parent's rate if higher than the child's rate. So basically, it now falls back and gets taxed at the parent's tax rate and not the child's rate. So basically, if you have to file a return and these rules apply to you, you would have to include this Form 8615 with your return to pay the appropriate amount of tax on that portion of the income that exceeds the child's rate. So keep this in mind. Now, the kiddie tax, the software that most of you, as I indicated earlier, that you'd be using, TurboTax, accommodates this calculation. Whether it's TurboTax or any other tax software, they're all menu driven. And when I say menu driven, basically you start at the beginning and you sort of wander your way through the tax software. And the tax software is designed for those individuals who know absolutely, what the goal is of these software companies, especially TurboTax. TurboTax has been around a long time. They know what they're doing. It's a good product. And so I don't use it only because it's not a professional tax product, but basically it's good for those who are unversed with regard to the tax laws. The point I'm trying to make is it's all menu driven. And basically, I think the downside to it, so to speak, is it can be a bit tedious. But the fact of the matter is you're being asked certain questions for a variety of reasons. And along the way, in terms of preparing this tax return, when you indicate that you are an individual between the ages, that you're a full-time student between the age of 19 and 24, you're going to start seeing questions that have some relevance to the fact that the kiddie tax may apply to you. So it's very important that in going through this process, you answer the questions and you answer them correctly. If they're incorrect, then obviously you could be led down a path where it's quite possible that if the kiddie tax applies to you and you misunderstood the question, answered it incorrectly, innocently in that respect, the application of the kiddie tax may apply to you, but the final return does not reflect the fact that the kiddie tax applies. So you've got to keep all of this in mind. So keep that in mind, whether it be for this purpose or for any other purpose for that matter, because there is some relevance in terms of answering these questions correctly. All right, so getting back to this Form 8615, basically it's a separate form that is prepared and attached to your return. And basically what it is, it calculates the tax on that portion of the income at your income at your parents' rate. So here we go. Who must file the form? Form 8615 must be filed for any child who meets all of the following conditions. The child had more than $2,200 of unearned income. When we talk about unearned income, we talk typically about interest and dividends. And one additional amount of unearned income, namely a taxable scholarship. That portion of your scholarship that's taxable, that stipend, that is considered unearned income. So that may clearly bring you over the threshold of $2,200 in your particular case. the child is required to file a tax return. Now, if you're a single taxpayer, what's the filing requirement to file a tax return? If your income is greater than $12,550. So if your income is less than $12,550, then this condition doesn't apply and you don't have to attach file form 8615. In that instance, you may not have to file an income tax return. Next, the child is either was under the age of 18 at the end of 2020, and let's change that to 2021, or the child was age 18 at the end of 2021 and didn't have earned income that was more than half of the child's support. What they're saying there is this: if you worked a job and you earned, let's say, $20,000 working that job, if that $20,000 represents more than one half of your support, then you don't meet this condition. Because essentially you have a sufficient amount of earned income to meet your particular support. Now, when we talk about support, what we're talking about is, and you can get into this in great detail, but basically what we're talking about is what it costs you to live during the course of the year. And what does that include? It includes your education. It includes the roof over your head. It includes the food that you eat. It includes the clothes on your back and so forth. There is basically criteria that you can follow that the IRS provides to establish who has provided more than one half of your support. So if you did not provide more than one half of your support, this condition would apply. And then finally, the next condition is, was a full-time student, you were a full-time student at least 19 and under age 24 at the end of 2021, and didn't have earned income that was more than one half of your support. That's the same position that we're talking about in section B. So basically that one half support issue comes into play. Number 4, at least one of the child's parents was alive at the end of 2021. So obviously if both your parents are deceased, the kiddie tax does not apply. And then finally, the child doesn't file a joint return for 2021. If you're married and file a joint income tax return, the kiddie tax does not apply to you. So a lot of things to keep in mind, a lot of things to remember, but basically it all comes back to making sure that you input the information accurately and correctly when preparing your return. All right, let's move on to the next slide. Filing requirements continued. Non-resident taxpayers, really, there's nothing for us to discuss here. If you're considered a non-resident taxpayer, you don't file Form 1040, you file Form 1040 NR, obviously the NR representing non-resident taxpayers. So that's for sort of, for your information only. Filing options, as I stressed before, you should consider filing electronically. I'm sure many of you will, if not all of you, for that particular option. If you're using TurboTax, I'm sure TurboTax has the ability to allow you to file electronically. I think TurboTax, their sort of business model is you can get the federal tax version for free, but you have to pay for the state. So they get you one way or the other, but basically they have an option that will allow you to file electronically. You can file for free through the IRS, and there is the link for that. If your taxable income is less than $69,000, and for most of you, I suspect that may very well be the case. So you can file your federal income tax return if your taxable income is below that threshold and not have to pay a fee. So there's the link for that. And the state has a similar setup as well with regard to Massachusetts with regard to filing a state return. So it's becoming more and more accessible. And it makes sense. I mean, basically, prior to this whole electronic filing, the federal government and the state governments have to handle a lot of paper. And that obviously amounts to having a significant staff available to be able to do that. With electronic filing, they can eliminate those particular positions, speed up the process. So more and more and more accessibility to electronic filing is available today. So it's out there. All right, next slide. All right, reportable income. Let's talk about reportable income. And as I stated, if you're a US citizen or resident alien, you are taxed on your worldwide income. You report all of your income from whatever source derived, examples of which salaries and wages, taxable fellowships, scholarships, and grants, bank interest and dividends, investment income, royalties, prizes, awards, any real estate activities, whether it be from rentals or sales, are all reportable. So basically, these are things that you have to keep in mind. All right, next slide. Basically, in terms of filing an income tax return and why you have to file an income tax return, it's pretty simple. It's the law of the land, so to speak. In the law of the land, basically what governs the filing of income tax returns is what is known as the Internal Revenue Code, the IRC, the Internal Revenue Code. In one section of the Internal Revenue Code basically says it all, and that's section 61 of the Internal Revenue Code. And basically what section 61 says is this: except as otherwise provided in this subtitle, gross income means all income from whatever source derived, including but not limited to the following items. So if you go to the Internal Revenue Code and you look up section 61, that's what it says. So here we go. All income is taxable except as otherwise provided. So basically the government, the tax code is designed to say it's all taxable. And then hopefully what we're looking for is some other section of the Internal Revenue Code that excludes that type of income from being taxed. All right, an example of which is, I don't know the code section offhand, but there's a code section that exempts life insurance proceeds. There's a code section that exempts inheritance and so forth. Then there's many, many code sections that exempt different sources of what would otherwise be income under section 61. The section that we need to gravitate toward to allow us to exclude our scholarships, because basically if we're going on section 61, basically scholarships, fellowships, and grants would all be taxable. But fortunately, there's section 117. And what section 117 states is gross income does not include any amount received as a qualified scholarship, and we highlight that, qualified scholarship, by an individual who is a candidate for a degree at an educational organization. So if we can move on to the next slide. Here we go, taxable versus what's taxable versus non-taxable. Your fellowship, scholarship, or grant will be non-taxable if the following conditions are met. The individual is a candidate for a degree, and I suspect there's no question out there that all of you are candidates, at an educational institution that maintains a regular faculty and curriculum and normally has a regular enrolled body of students in attendance at the place where it carries on its educational activities. I don't think there's any doubt that that's what Harvard University is in the business of doing. Next, amounts you receive as a scholarship or fellowship grant are used for, this is important, the amounts are used for tuition and fees required for enrollment or attendance at the educational institution, or for fees, books, supplies, and equipment required for courses at the educational institution. These are known as qualified educational expenses. So if your scholarship is paid for qualified educational expenses, then that portion of your scholarship is not taxable. And I think for many of you, basically, those amounts that go toward your tuition and required fees, et cetera, you don't even see. Those amounts that are applied to your account, and you have basically not, you don't even touch that money. You don't see it. It's applied to what we could call as qualified educational expenses, the tuitions and fees. Now, the funds that are available to you that you can use at your discretion represent, in essence, the stipend you're receiving that, for the most part, is to help pay for your room and board. So those amounts are what would be taxable. So to move on, if amounts are used for incidental expenses such as room and board, travel, optional equipment, and generally amounts received as payments for teaching, research, or other services required as a condition for receiving the scholarship or fellowship grant, those amounts are taxable. So the general rule, bottom line, that monthly stipend, no question, is taxable, unless you're using a portion of that for qualified educational expenses. And if that's the case, then that monthly stipend can be reduced by those amounts that you deem to be qualified educational expenses. All right, so keep that all in mind. And all right, let's move on to the next slide. All right, reporting taxable fellowships and scholarships. Basically, if you're so interested, the Internal Revenue Service, and you can go online, irs.gov, IRS publication, you can look up IRS publication, worksheet 1-1 to compute your taxable scholarship and fellowship amount. Basically, you can go through that gyration if you want to sort of satisfy yourself in terms of arriving at what's taxable. But basically, for the most part, that monthly stipend is where you're going to begin in terms of what you need to report on your income tax return. All right, reporting mechanisms to the IRS. I talked about this earlier. You know, W-2s, if you get a W-2, not only do you get a copy, the IRS gets a copy. Form 1099 miscellaneous or a Form 1042S. These are all tax forms that the IRS issue, that the employers or payors issue to the recipients, copies of which go to the IRS. And then we talked about the fact that the stipend that you're receiving is no reporting mechanism. So no one is aware of what you're receiving. But again, as I indicated, the tax system is one that it's a volunteer system, and you report what your income is honestly. And down below, you'll see, this is just to reiterate what I did back on the first slide. You indicate what amount is taxable on line 1 and make that notation SCH to denote that it is a taxable scholarship amount that you're reporting on that line. All right, next slide. All right, let's talk about paying your taxes. Now, if you're paying, basically, if you're receiving a stipend, if this is your first year, you started in August, September, August, you might have received 5 or so stipend amounts. If you're a full year student, you may have received a full year's worth of amounts. I'm not sure how many payments that represents. It may be 12 payments, 10 payments, or whatever the case may be. But obviously, if you're receiving some type of financial aid for part of the year, it's likely that it may not add up to exceed the threshold that you have to file. I don't know what the stipend, typical stipend is at this point in time. I suspect maybe about $3,300 a month. That's just my sort of best guess. And if you were receiving $3,300 a month, that's $16,500 a year. If you're a single taxpayer, 16,500 exceeds that threshold of 12,550. If that's the case, for example, if your taxable stipend is 16,500 or thereabouts, you're a single taxpayer, you subtract your standard deduction from that, you will have taxable income that you have to report. And for 2021, the tax on that taxable income of roughly about $4,000 is roughly $400. So that's what you're looking at if you're a first-year student, give or take a few dollars one way or the other, if I haven't estimated the stipend correct. And for state tax purposes, you're looking at about $600 that you might owe the Commonwealth of Massachusetts potentially. So the next question is, since the university didn't withhold any taxes from your stipend, it's your responsibility to remit taxes to both the federal and state governments if applicable. So the slide leads off stating that for federal and state income tax purposes, all taxpayers who expect to owe $1,000 and $400 respectively are required to pay an estimated tax. So basically at the beginning of the tax year, theoretically at the beginning of 2021, you should have all sat down and asked yourself that question. Will I owe the federal government $1,000 or the state government, Massachusetts in this case, $400? And if the answer to that question is yes, you should have been sending them an estimated tax payment. And basically that estimated tax payment is broken down into quarters, although the dates aren't exactly on a quarterly time frame. But basically, if, for example, you owed the federal government, you believed that you would be owing the federal government roughly $1,000, you would be sending in quarterly installments of $250. And if you owed the state $400, you would be sending the state quarterly estimates of $100. Those due dates are set forth there, April 15th. So again, at the beginning of 2021, you asked this question, and then by April 15th of 2021, you begin making your installment payments, the first of which is due April 15th, the second, June 15th, the third, September 15th, and the final one, the January 15th of the following year. So if you paid them religiously, you would have sent the government $250 a quarter under my example. And by January 15th of 2022, you would have paid your estimate in full. Now, what does that buy you? Basically, the bottom line is this. It buys you the ability to avoid being penalized. Because if you don't pay the estimated tax, it's possible that you could be subjecting yourself to penalties. And basically, the way to avoid those penalties, as stated there, in order to avoid the penalties for underpaying of your estimated tax, the total of your estimated payments for the current year must be greater than 90% of the current year's liability. So in my example, if we estimated the liability to be $1,000, if you paid in $900 or more, you would not be subject to any penalties. That's the threshold. Or if you paid 100% of your prior year's tax liability. So if in the prior year, your tax liability was $1,000, in the current year, you paid in $1,000 of estimated taxes, you would avoid any penalties, all right? Regardless of whether you've been good about it or not, at the end of the day, your tax is due in full by April 15th of the following April 15th of the 15th following the close of the tax year. So everything is due and payable then. If you don't pay it all in full by April 15th, you're subject to more penalties. So Those of you who are receiving stipends and those of you who have received the full year's worth of stipends, you need to make sure you address this because it can add up fairly quickly. All right. Lastly, in terms of making these installments, you do have the ability to pay these payments electronically. And there are a couple of links there, one for the federal government and one for the Commonwealth of Massachusetts, where you can go online, provide your banking information, obviously your tax identification number, and the amount that you want to pay, and they will cheerfully take it from your account. And again, as I stated earlier, these systems, so far so good, have been pretty secure. If you prefer to send the government a check, you're a bit hesitant in terms of using any type of electronic system, you can send them a check. My suggestion is that you use a particular tax form. For the IRS, there is a tax form, it's labeled Form 1040-ES. That particular form, it's simply a transmittal form. It just basically identifies who you are, your social security number, and that you're paying an estimated tax for a specific tax year. You will send the form to the address indicated in the instructions along with your check, and it will be processed. The same applies with the Commonwealth of Massachusetts. The form that you would use there would be Form 1-ES, and that would accompany your payment when you send it along. So, each option, it's totally up to you how you want to handle it. That's your decision to make. All right, lastly, and very quickly, is next slide, next couple of slides, educational tax credits. It's possible that you may be available to educate some educational tax credits. The two that are available these days, and one of these, not both of these, because the fact of the matter is the first one, the American Opportunities Credit, is only available to students in their first 4 years of post-secondary education. So, your undergraduate program, we're dealing with you folks in a graduate program. So that credit is not available to you, and it's very likely that that credit was, if available, was utilized by your parents. The next credit, lifetime learning credit, is possibly available to you. Bottom line is the credit is up to $2,000, and it's 20% of the first $10,000 of qualified educational expenses that you pay. And when I say you pay, essentially what has come out of your pocket. If your graduate school education is totally financed through scholarships and fellowships, then essentially you're not paying for it. So if there's any portion of that expense that is paid out of your pocket, then it's possible this lifetime learning credit would be applicable to you. The maximum amount would be up to $2,000 in any one tax year. So keep that in mind. Take a closer look at that to see if that may apply. All right, next slide. Student loan interest. In the event you've incurred any student loans and you're paying interest, that interest is deductible on Form 1040. Here are the rules behind it. Basically, it's up to a maximum amount of $2,500 that was paid. It's on student loans that you are indebted to pay. And if you've paid interest during the year, typically you will be notified of the interest that you paid. If so, that amount is deductible on Form 1040. The only criteria that could come in to sort of haunt you in terms of taking the deduction is that it phases out. But I suspect at this point in your career, that's not going to be an issue. When I say phases out, if you've earned more than $85,000, the deduction is no longer available. or if you're single, and if you've made more than 170,000, the deduction is not available for a married couple. So take a closer look at that. If you have any interest to deduct, you can do that on your Form 1040. And then lastly, the next slide, for Massachusetts filing purposes, basically, a couple of things you have to keep in mind, and this may vary for many of you. For Mass state income taxes, you were deemed a full year resident if you maintain a permanent place of abode in Massachusetts and you spend more than 180 days of the taxable year. Now, if you're a graduate student living in university housing or dorms or whatever the case may be, you would not be deemed a Massachusetts resident. And if you're not a Massachusetts resident and your only source of income is a taxable scholarship, then that amount of income is not taxable on a Massachusetts return. Now, depending upon your family situation, it's possible that you may still be dependents of your parent. And if that's the case, generally, if you are, you may very well be a resident of your parent's state return. So that's something you need to sort of keep an eye on, so to speak, and understand exactly for Massachusetts tax purposes. You know, if you're living in a dorm, you're not a Mass resident. So that takes care of that. But if you're in a different residential situation, it's possible you might be. So you might want to coordinate things or get a greater understanding as to what your status is with regard to your parents and so forth. If you're not a dependent of your parents and you're in Massachusetts and you're in non-university housing, then I would say you're a resident of Massachusetts. And for income tax purposes, if you have earned more than $8,000, you would have to file a Massachusetts return. And then last slide, very quickly, if it's possible that you may, be coming in from another state. I'm sorry, one more slide, I'm sorry. If you're coming in from another state, possibly relocating from California to Massachusetts, it's possible you may have to file returns in both states as part-year residents and so forth, depending upon, your circumstances in terms of what you were doing in either state. So that's quite a bit for you to think about, and I think we're well overdue to get to some questions and give some answers, and we'll go from there. Lisa?
Yes, we have a number of questions, but most of them seem to be centered around the estimated taxes. So I'll just start rattling some off. Can you use TurboTax to pay your estimated taxes?
I honestly don't know. I mean, in terms of, it's certainly something you can look into. They may have some type of menu or link which would allow you to pay through that system. Don't forget, the estimated taxes are due during the course of the year. Mm-hmm. TurboTax, and I might be, when I say I might be mistaken, obviously, if there's a feature in the software that allows you to pay estimated taxes, that's wonderful. As I pointed out on one of the slides, there is a link where you can go directly to the IRS and pay your estimated taxes through that particular link, whether it's through TurboTax, if that's available to you, or whether it's through that link. At the end of the day, you're paying what you have to pay, and it ultimately ends up in the hands of the Internal Revenue Service. And let me just say this, the IRS is very, very, very good at keeping track of your money. It's been very rare in the 40 plus years that I've been doing this. It's been very rare that the government is misapplied payments. So obviously, if you're paying an estimated tax online, you're providing the IRS, obviously, with the appropriate information, namely your name, I suspect maybe an address, and more importantly, that all precious Social Security number. If you're providing all of that accurate information, that sum of money that you're remitting at that point in time is being placed into your account, so to speak. And when you ultimately file your return, you're going to reflect on the return that you paid a certain amount of estimated taxes. And the IRS will confirm that based upon what they've received from you. And obviously, if you enter in the correct amount on the return, and the IRS has the same amount in escrow, so to speak, on your behalf, you will get full credit for those payments. So keep that in mind.
If this is your year, the 2021 tax cycle has only 5 months of scholarship income, do you need to file estimated taxes?
If you have 5 months of scholarship income, that the question?
That is.
What would that roughly be? Was my estimate close? I figured it to be about 16.5, about 3,300 a month.
It's actually, I think for most of our programs, it's around $3,200 a month.
All right, so I overestimated. All right, and basically, I threw out some real numbers. Based upon 3,300 a month in receiving 5 installments, you would have a total of $16,500. Your federal tax obligation would be $413. Now, as I stated, if you expect your estimated tax to be greater than $1,000, you need to begin paying. So in this case, as long as the individual files a return and pays the tax by April 15th, 2022, you're all right. You won't be penalized.
Okay.
Right, so in that instance, the first year student just receiving 5 installments of their stipend, they can wait until April 15th to file and pay what they owe, and they'll be in the clear. But don't forget, guys, come April 15th of 2022, you reset the clock and you start over again, because that's the first day that you will owe an estimated tax for the new tax year 2022.
Okay.
So keep that in mind. Right?
Okay. Next question. It says, say we worked a paid job where taxes were taken out of our checks, January up until the time they started the graduate program.
Yep.
I think what they're asking is, because they've been paying taxes, should they now, they've had taxes withheld from their pay, should they now start paying quarterly on these months, or could they wait and file at the end of the year?
Well, it all boils down to, again, as I stated, come January 1st of every year, you've got to ask yourself that question. Now, I understand the circumstances. For the first 7 months of the year, an individual was working a job, having taxes taken out. The $64,000 question is this: were there a sufficient amount of taxes taken out of his pay to cover what he owes in taxes on that pay, plus what he owes in taxes on, or he or she owes in taxes on that stipend? And the only way to determine that is essentially do an estimate of what your tax liability is. And what I mean by that is, if the individual earned $20,000 working and earns another $15,000 in stipend, that individual's combined income is now $35,000. And what that individual has to do at this point is to project what the tax is on the $35,000 and compare what the tax is versus what was paid in. If there's a shortfall, then they need to think about paying an estimated tax to make up that difference.
And should use the same form as anybody else for calculating the estimated taxes.
Yeah, I mean, basically what a lot of people do is essentially, for example, if in 2020, you use TurboTax to do your 2020 return, all right? Now, the 2021 TurboTax program hasn't been released yet. So what you would do is you would use the 2020 program and sort of recreate what your tax liability is going to be. Things haven't changed all that much from 20 to 21. So I would do a mock-up return based upon the information I have and see what result I get and determine whether I'm coming up short or whether I'm in good shape and I've paid in enough. That's basically how I would approach it.
Okay, great. Next question is a student that has switched from being a non-resident alien to a resident alien mid-year. And so non-resident aliens often typically have taxes withheld and now they're not. So how does this impact the estimated tax owed? Would that be the same situation that we just talked about, that they'd have to still fill out that estimated tax return?
Well, I guess the question for that particular individual would be, would they be filing dual returns? Do they need to file a non-resident return and file a resident return? Would they be a part year non-resident and a part year resident? That's a big question. Typically, if you become a resident alien, it would typically be at the beginning of the year. So that question maybe needs a little bit more refinement. My suggestion would be maybe if that individual would like to expand his question by sending me an email with a little bit more information, I think I could be more specific.
Okay, great. Another question, if you earned income at the beginning of the year in another state, do you pay Massachusetts state taxes or the other state taxes? So how do you determine where you should be paying your taxes, Bob?
Well, in that instance, basically, that individual, I would say, would be filing a part year resident return for that first part of the year. Let's say they were coming from California. So they earned a wage through that point in time. I suspect it's probably safe to say that that individual's residency in that state terminated once they got to Massachusetts. So I would file a part year resident return for that state for those earnings through that period of time.
Okay.
And then for Mass purposes, we'll establish that person's residency, whether they are a resident of Mass or not. If their sole source of income is strictly from a taxable stipend, and if they're living in university housing, that income is not taxable in Massachusetts.
Okay, so our students that are living in our dormitories, they're not considered, residents for tax purposes. But if they're renting an apartment through Harvard Real Estate and they're living here 12 months of the year, then they would be considered Mass residents for tax purposes?
I would say so, yes.
Okay.
Yeah.
All right. Next question. If you're filing taxes jointly with a spouse, are estimated taxes calculated only for your portion of household income or for the total gross household income? So what do married students do?
Yeah, well, if you're a married individual taxpayers and you plan on filing a joint income tax return, which is to your advantage, you would combine your income to establish what your estimated tax liability would be. So it's the combination of both taxpayers in all income earned by each.
Okay. Next question. I recently learned there are a few nonprofit organizations that offer free tax preparation to students. Do you recommend making use of these organizations? Are there any places you think we should avoid?
Good question, and I wish I could answer it. I don't have much experience. I know there are those organizations out there that are available to you. What I did experience this past tax season with the COVID situation, I had a couple of instances where people came to me where they would normally go to one of these organizations to have their taxes done. They couldn't get an appointment because of restrictions in terms of people, physical presence and so on and so forth. So it was very difficult. I assume things are going to be a bit easier this year. As far as specific organizations, I can't speak of any, and I can't speak ill of any, to tell you the truth. So,
Okay.
All
right. One last question I think that we have is there's a graduate student in DMS wants to know if his stipend is considered a scholarship. His worker appointment letter says that they are a salaried research assistant. And I conferred with my colleague who handles the DMS, and she tells me that G1s and G2s do receive stipends, but all science students are considered Harvard Graduate Student Union eligible, so they all get a salary letter, even though they're receiving a stipend. And so those students will not get a W-2. They are receiving stipends, and those are considered taxable income.
I would say so, sure.
And I think, let me just check and see if we have, there's one more question. And that is, am I hearing correctly, the G1s, we shouldn't worry about estimated tax until the next cycle? Wait for the reset in April? Seems like that would make things less confusing. Well, I think.
Well, again, if this is an individual, the initial year for the individual starting in August, September, they really don't need to worry about worry about estimated taxes, and they can pay their obligation in full come April 15th.
Okay. All right.
But then, as I warned earlier, the clock resets itself, and you have to start thinking about the new year, and that's going to be a full year ahead of you.
Okay, great. Okay, that is all of our questions. Thank you very much, Bob. We are at time. Thank you once again for a very informative presentation, and we will be posting this to the GSAS website as soon as we possibly can.
Excellent. Well, I appreciate the opportunity. And again, those who are still on board, if you do have any questions that come up down the road, feel free to shoot me an email, and we'll get back to you sooner rather than later.
Wonderful. Thanks again, Bob.
Thanks,
All
Bob.
right.
Have a
You're
good night.
welcome. Thank you. You too.
Bye.
Bye now.